Good afternoon, everyone, and welcome to the second webinar in our series coming out of our annual TSX 60 Proxy review. Today's session will focus on emerging trends in the intersection between executive compensation and environmental, social, and governance factors, or more commonly referred to as ESG. For those of you who don't know me, my name is Bridget McKellar, and I'm a principal with Hugessen Consulting based in Toronto, and I'll be your host for today's webinar. Joining me today are Jean-François Malo, who's a manager in our Montreal office, Emily Parsons, an associate in Hugessen's Toronto office, and we also have with us today Deborah Beckman and Olivia Vooris, colleagues from Semler Brossi, our affiliate partner in the US. So thanks all for being here today. To help us navigate the next hour or so, we've divided the session up into 3 segments. First up, JF will focus on what we are seeing with respect to environmental factors in compensation programs and shareholder activism. In our second segment, Emily will speak to the emergence of diversity, equity, and inclusion within compensation programs, the ongoing evolution of board and management diversity policies, and how shareholders are addressing these issues. And then finally, Deb and Olivia will provide us with some flavor for how these trends are evolving in the US market. We've also left time at the end of the hour to bring all of our panelists back together and answer your questions. Before we get started, a couple of housekeeping items. All participants are in listen-only mode. Questions can be submitted through the live event Q&A feature on the right-hand side of your screen as the session proceeds. And today's slides will be shared with all participants at the end of the session. We will also be sending out a very short survey after today's session. We would appreciate if you could fill it out. We welcome your input into how we can improve for future events. Now, before we dive into the meat of the presentation, I did want to set the stage for why we are here today. Essentially, why does this matter for boards? The reality is that the oversight of ESG is now a core board responsibility. Institutional investors want sustainable returns, and employees and other stakeholders want ethical climate stewardship and actions on important social justice issues. Boards are expected not just to talk the talk, but to walk the walk when it comes to ESG. Stakeholders are demanding concrete actions in the form of strategic plans, capital allocations, and meaningful change in board and senior management composition that reflect the public statements of support and commitments made by organizations, including some of the largest corporations in Canada and the United States. We've included on this slide for your reference a number of actions that high-performing boards are taking as they continue to navigate the changing ESG landscape. These are informed by our firm's work with boards through our board effectiveness practice. To briefly elaborate, directors are educating themselves about ESG issues and potential ways of addressing them. In doing so, they're leveraging both management teams and outside resources to get the information they need. They're driving refreshes of strategy, ensuring that directors understand material climate-related risks and opportunities, and ensuring that capital is being invested ethically and in line with stated corporate purpose and values. Setting robust goals with the CEO is important, ensuring that the board and CEO are aligned around what great performance looks like, particularly as it relates to some of these newer ESG metrics that are evolving. They're creating meaningful linkages. This related to the previous one, creating meaningful linkages between material ESG related performance and executive compensation, and more on this topic especially to come today. Continuing and hastening board renewal is another important feature. This is being done so that board composition reflects both strategic imperatives and diversity commitments of the organization. Leveraging feedback processes, including board evaluations, director peer feedback, and in-camera sessions, support the board in continually raising the bar for itself. And last but not least, ensuring meaningful disclosure around ESG strategies, goals, and progress towards achieving them. This includes the disclosure that comes in the compensation discussion and analysis section of the annual Proxy circular, as many people on this webinar will be familiar with. And with that, I will hand you over to JF.
Thank you, Bridget. So I'll kick off this session with a focus on the E of ESG, or also known as the environmental factors. And we'll be looking both at the ESG in incentive programs, but also the shareholder response to the ESG, which would also include itself a look at the shareholder proposal and the say on climate landscape. So looking at the TSX 60 this year, While we do see an increase both on the shareholder front and in the boardroom, with regards to the ESG and compensation, it remains steady in terms of presence in the TSX 60 at around 63% year over year. When we look at the actual design of those plans, or how ESG are actually incorporated in the incentive plan, the STIP remains the most common vehicle to do so in the TSX 60. When some of the companies are explicitly disclosing the carve-out portion of their incentive that are related to ESG, and on average, this represents 20%, and that remains true for STIP or LTIP integration. So let's take a look at what companies are actually measuring, and that gets me to the big graph on the left-hand side of the slide. So first, let's look at the E column in orange. As you can see, this is a quite popular set of measures with 14 occurrence, but we do know that 11 of those are coming from the materials and the energy sector. And these measures were mostly backward-looking. In other words, these companies or these industries are more looking to at disaster avoidance, compliance to industry standards or industry benchmark. And all of those are very central to their operation in these given industries. When we look at companies who have forward-looking measures, such as green gas emissions, that remains marginal. But as these practices or the ESG become more common and it matures, we do expect that environmental measures such as greenhouse gas emission may drift towards the LTIP at some point because it's typically attached to a longer-term climate strategy at some of these companies. Still in this graph, the middle bar in blue are the S, or the social aspect, which will be covered with my colleague later during this webinar. And then finally on the right, there's the two columns in gray, which some of you may not consider those as leading measure, but they still technically fall under the realm of ESG measures. And we have health and safety, which at one point in time, it was a leading measure, but it has evolved to become expected, especially for the extractive industry. And maybe this is a similar path that some of the environmental and social measure will take on later on, but there's still a long way there. And the last bar is the customers. They represent other key stakeholders, and one could argue it's more of an operational measure because it's more core to the company strategy, but it still falls under the ESG. And the customer measures, we see those more often in the financial sector and the telecom sectors. So despite the high interest and discussion in the boardrooms, and especially during COVID, new inclusion of ESG in compensation remained modest in 2020. These conversations started in 2020, but by the time it gets into compensation, it wouldn't be surprising that you see more of these examples next year in the next proxy season. In any case, we encourage our clients to consider ESG in their compensation programs, but the caveat is this is not a simple task. In any case, when you design these type of plans, the key is to maintain the pay for performance. So you would want to avoid to bolt on an ESG measure just to check a box. The best measures that are included in compensation are typically the ones that are trickling down from your ESG strategy, and the best ESG strategy typically trickles down from the corporate strategy. So hence the complexity of the whole discussion on that front. So going down a little further, when you're setting your targets, and this might pertain a little bit more to the ESG strategy itself, but companies have to be careful. Over the past few years, we saw a few companies receiving some negative attention when setting goals very far out, like, for example, the 2050 mark. While directionally, it's positive, it's outside the current strategy, which is probably more a 3 to 5 year, and the current management team, which most likely won't be in office in 2050. Hence the greenwashing criticism that attracted over the past few years. So on this page, we selected 3 examples of ESG in compensation. All three, Algonquin, Power, CNRL, NTD, have the same type of approach. They've selected an ESG blended approach, which is also the most common way to integrate environmental factor in compensation in the TSX 60. And they all carved out a notable portion of the incentive for the ESGs. We're talking a 10 to 20% carve out. Now, if we look at the actual disclosure of the underlying measures included in the blend, it's very lean. And the objectives of those measures even leaner. This approach is completely fair. The topic of ESG remained fairly new, and it gives some sort of leeway to the management and the company and the board to readjust the calibration and which measure are the most effective as their processes mature and the ESG space matures as well. So now let's take a look at the shareholder proposal this year. So in 2021, so the first few months of 2021, there were 79 shareholder proposals, which were themselves focused on 19 companies of the TSX 60. This is nothing out of the ordinary here. Most of them, as usual, were withdrawn, but 21 actually got it voted on, and one actually passed, which we'll get back to in a moment. So on this graph, and you'll see a similar graph in my colleague's section addressing the social aspect, we've organized them by teams, so environmental, social, and governance. And if we start with governance at the bottom of the page, one interesting fact that we raised is this 6 shareholder proposal that were asked to include ESG in compensation, which itself reflects once again the market sentiment and desire for having more company embracing ESG and making it count. On the environmental front, most of the proposals were put forward by the MEDAC, notably the 2 big ones, the climate disclosure and the circular economy proposals. For those of you who are a little less familiar with MEDAC, MEDAC is an organization with a mission to educate on financial market and defend small shareholders. And one of their most visible campaign is the shareholder proposal they put forward to some of the big TSX companies every year. Also in the environmental section, we also found interesting that the 4 that you see for the greenhouse gas emission strategy were all put forward by other shareholders or shareholder groups. And some of those 4 had significant level of support, especially the one, well, for example, the one at RBC, where there was a level of support north of 30%. And finally, on the environmental part, there's this one proposal of say on climate at CP. And this is the one who passed this year, and it's actually a good segue to our next section where we're going to address the say on climate. So say on climate, for those of you who are less familiar with it, this is very similar to the say on pay in the sense that it is a non-binding advisory vote, but this is on the climate strategy of the organization. And this topic had gained a lot of traction this year, especially in Europe, but also fairly in North America. It's still in an early stage, but it's gaining a lot of momentum, and maybe it's going to follow the path of say on pay, but again, we're still a way, there's a long way before getting there. So in Canada, specifically, if we look at the left-hand side of the slides, a lot of the investors share the similar lens. They want to improve the climate agenda, but there is also a range of views on how to address or how to think about the say on climate vote. For example, we have Glass Lewis, who has voiced that they will generally recommend against a proposal of say on climate. And really what they're after is the fact that they want to avoid giving a rubber stamp on climate strategy for organization. And on the other hand, you have, for example, La Caisse de Dépôt or CDPQ, a very sophisticated investor who also announced that they would typically support these proposals because for them, it's creating an additional lever to promote long-term investment. The number of companies in Canada having a say on climate, it's only 2 companies for now. So CN actually had the vote this year. CP announced through the shareholder proposal, most likely it's going to be next year. So these are voluntary, but in the next few years, we could expect to see a little bit more like we see in Europe, where some of the oil and gas company and some of the consumer products have been targeted and announced that these sort of votes will happen in the near future. Also on this same vein, the climate activism front, we do see a growing interest for some of the climate activism, and some campaigns attracted some more attention this year. And one of the visible climate activism campaign was the Vote No campaign. So for example, the Majority Action, this movement or organization, had a campaign to vote against directors that have failed to set emission targets or climate strategy to limit global warming below the 1.5 degree. And earlier this year, some of the most recognizable name where they did some campaigns toward them, it's Goldman Sachs, JP Morgan, and Berkshire Hathaway. And they all got some sort of negative attention through that. On the oil and gas sector, there's also a lot more scrutiny this year. And we selected 3 examples of international company that you might have heard from. So we have first Exxon, Chevron, and Shell. So first at Exxon, what happened there is there was an activist investor, and they were able to appoint 3 dissident directors on the board. And the backstory was climate transition, governance, and director expertise. And for context, a company of that size in the US, it's very rare to get 1 dissident director appointed for any reason, so let alone 3 for environmental. So you see that there's a lot of traction on that front. Then you have Chevron, where they had a shareholder proposal on a climate-related accounting and climate strategy that got over 60% support rate. So again, giving up the fact that shareholders and people are very environmentally driven, and it's a subject of interest. And finally, there's a Shell case, which is a little different here. It's not really activism, but the Dutch court ordered Shell to deepen their emission cut as part of their climate strategy. So it's coming from the court. And while Shell is appealing for this ruling, this could put wind under the wings of the legislator all around the world. So maybe something to stay tuned for the next few years. So with this, it concludes the environmental section of the presentation, and I'll pass it to my colleague, Emily.
Thanks, JF. So now we'll turn the discussion to the social pillar of ESG. So as JF outlined previously, there are several instances of ESG measures in compensation among the TSX 60. So metrics included in the social bucket, shown in blue in the center, include talent, which encompasses employee measures, including diversity, equity, and inclusion, community measures, and corporate social responsibility. So starting on the right with the community and CSR scores, we observe that the majority of companies with these metrics are in the materials or energy sectors. So you can imagine how these metrics would be relevant in these industries, and clearly the decision to incorporate these ESG measures are aligned with the company's business needs. On the left, the majority of talent-related measures are related to employee engagement or investing in people, and there's also 4 occurrences of companies using DE and I measures in their compensation plans. So on the right-hand side, to highlight a few, RBC has a 30% risk and strategic bucket in its STIP and front-end conditioned LTIP scorecard that is individualized for each executive. And some of those buckets of metrics include diversity and inclusion. At Barrick, each of the STIP and PSU scorecards are weighted 10% on human capital priorities, which include, quote, building effective industry-leading processes for attracting, developing, and retaining an effective multicultural, multi-generational workforce. And then finally, at Manulife, 20% of the STIP scorecard is weighted on strategic measures, including diversity and inclusion metrics. So in all these examples, we can see that the diversity and inclusion metrics are not clearly defined. So either these metrics remain highly subjective, or the companies are choosing not to disclose the specific measurement methodology. In 2015, as many of you may know, the Ontario Securities Commission and other Canadian regulators implemented a comply or explain rule in Canada, which requires most publicly traded companies to either comply, that is, implement a diversity policy for the representation of women on their board, or explain why they do not have such a policy in place. So in the illustration here on the left, the dark orange represents companies with both a diversity policy and target in place. The light orange represents companies with only a policy, and the gray represents companies without a diversity policy. You can clearly see how the number of TSX 60 companies with specific targets has increased since 2016, from 37% to 66%. On the right-hand side, we take a closer look at the 2020 TSX 60 makeup. So here, the percentage of female directors is shown on the x-axis, as compared to the number of companies that have a policy and or a target for female representation on the y-axis. On the left, you can see one board, Restaurant Brands International, has less than 10% female representation, while on the right-hand side, there are 3 companies with 50% or more female directors, which are Saputo, CIBC, and Fortis. Turning to executive diversity policies, it's important to note at the outset that there is no standardization in terms of who's covered by an executive diversity policy. So companies' policies may apply to different groups, and their organizational structures are likely quite different as well. So in order to come up with an apples-to-apples comparison, we've looked at the number of female named executive officers, or NEOs. So the disclosed NEOs are based on compensation levels, the top 5 in the proxy. So representation among this group is tied to the compensation and the continuing gender pay gap and leadership gap. So again, this chart shows the number of companies with gender diversity policies and targets in dark orange, policies only in light orange, and no policy in gray. As illustrated here, 30% of companies have a target for female representation among the executive team. However, we've yet to see many of those women make their way into the top 5 paid disclosed officers. On the right, the data is segmented by the corresponding number of female NEOs. So the majority of the TSX 60 have no female NEOs, 35% have 1, and only 2 companies have 2 NEOs. We'll also point out that there are no female CEOs. Overall, the trend toward female representation in the boardroom has been making significantly faster progress than women in management teams. In terms of diversity policies beyond gender, we found that a majority of TSX 60 companies have disclosed a diversity policy that applies to both gender as well as visible minorities and or other designated groups. Many of these companies have disclosed targets for these groups, though there are notably fewer than companies that have targets for gender diversity. We observed more companies setting targets for visible minorities among the executive team than on the board at 21% and 14% respectively. And most companies with diversity targets beyond gender set them for either the executive team or the board. There's actually only 4 companies that have both. We also note that financial institutions in the TSX 60 that had targets for visible minority representation, just an interesting point here, they only applied these policies to the executive teams, not the board. Now, moving on to shareholder proposals, we saw proposals under the S social pillar this year covering topics including diversity, human rights, disclosure, living wage, and more. And many of these proposals, as JF mentioned, were withdrawn following engagement with the companies, but they're still important to track. If the company had not reached agreements with shareholders, these matters likely would have gone to a vote. So notable social proposals include, at Saputo, shareholders requested that the company disclose a review considering the incorporation of ESG metrics and incentive compensation, executive compensation, and this received 11.3% of votes for. At TD, shareholders asked TD to set a target of over 40% diverse board members over the next 5 years, which received about 8% of votes for. And finally, an interesting one here at TMX Group, Atkinson Foundation came forward with a shareholder proposal to report on policies and practices regarding Indigenous community relations, recruitment of Indigenous employees, education on Indigenous reconciliation, and procurement from Indigenous-owned businesses. The board recommended against the original proposal, which you would see in the proxy statement, but following engagement, they supported an amended proposal that was softened somewhat. It includes developing programs, engaging with Indigenous organizations to support their work, and more. So at the end of the day, ISS and Glass Lewis both recommended for this proposal, and it passed with 98% support. Finally, just an overview of the regulatory environment on these topics. So in January 2020, the CBCA required publicly traded securities to provide shareholders with information regarding their diversity policies and practices for both the board of directors and senior management. So this enhanced disclosure requirements include, in part, the presence of diversity policies or targets for representation from designated groups at the board and senior management level. And as a reminder, these designated groups refer to Indigenous peoples, persons with disabilities, and members of visible minorities. And the guidelines also require disclosure of the actual representation of these groups. So coming out of this year, we observed 3 trends. So first, now that we're seeing the actual representation, outside of large companies like those in the TSX 60, it's become clear that there is very limited representation of women and other designated groups on the boards and senior management teams. Second, given this is only the second proxy season that this requirement is in place, we expect there are still compliance issues in reporting with incomplete and/or inaccurate information, especially given that many companies have not actually gathered data on diversity until now. And finally, it will be helpful to view these trends over time as companies continue to disclose this data. So now I will pass things over to Deborah from Semler Brossi to provide a US perspective.
Thank you very much, Emily. So we've spent a lot of time at Semler Brossi similarly studying ESG and links to incentives across the Fortune 500 companies. So if we can just go to the first slide. A quote here from Larry Fink in his letter to CEOs, Larry Fink, the CEO of BlackRock. The large investors are extremely focused on ESG in the US, and many of our clients indicate that as they talk to the investment teams, that is the #1 topic on their mind, and it has surpassed focus on traditional measures such as financials and operational metrics. So with that, looking across the S&P 500, what we found was 57% of the S&P 500 companies include an ESG metric in either their annual or their long-term incentive plan. Diversity and inclusion is now the #1 metric linked to compensation, and it has surpassed more traditional long-standing metrics such as customer satisfaction and safety. Other human capital metrics, talent development, turnover and retention, employee satisfaction, and company culture are also prevalent and in the top 10 metrics that we see in the ESG space. As you would expect, employee safety was within the top 3 in 2020, and we'll talk a little bit more about the year-over-year trend, but certainly in the midst of the pandemic, employee safety and wellness became an increased focus. Interestingly, and a bit different than what we talked about on the Canadian side, the environmental metrics are very small, and they don't represent a big percentage of the total in ESG metrics, and they really have been limited primarily to energy companies. Now, we do expect, with the focus of firms like BlackRock and some of the other large asset managers on the carbon footprint and net zero emissions, that over time the environmental metrics will grow in the US and be a more prominent part of the overall ESG equation and the link to compensation. And I would say, one of the reasons we think D&I is one of the most or the most prevalent ESG metric is certainly the growing national focus in the U.S. on racial inequality, brought to the forefront in 2020, and the increase in the overall focus on human capital management, driven in part by the SEC requirements that companies disclose how HCM metrics are material to their business strategy. And so that is also a new requirement this year. So we do see a lot of focus with our companies in the US with our clients around what are the right HCM metrics, how are they being monitored, how are they being measured, what are those year-over-year trends. And so a lot of focus on creating HCM dashboards for companies and boards to manage and monitor. Another thing that we've seen a lot of in the US, and we'll talk about some of the case studies later, but high-profile companies such as Nike and Starbucks have also made headlines because they've incorporated D&I into their go-forward plans. And we're seeing continued focus on this and continued requests from asset management firms and other shareholders. So we do expect that over time, there'll be more experience with measuring, managing, and disclosing D&I goals. And that there's going to be more and more pressure for these measures to become quantitative versus qualitative, which is the more common approach for companies today. Just head to the next slide. Another thing we did was just to kind of drill down within the within the S&P 500 around the top 200 and then the bottom 300. And what we did find was that there's more prevalence of the metrics in the top 200. So with 62% incorporating ESG into their incentive plans, whereas for the bottom 300, it was 55%. Also that the larger companies focus more on what we call sustainability metrics versus operational metrics. And so again, those longer term metrics such as diversity and inclusion and some of the environmental metrics, which we think tie to the longer term performance and sustainability, are more prevalent in the larger companies. This isn't really surprising, and we've seen this with other trends in the compensation space in the US, that the large companies will be the leaders here. They're the ones with the greater stakeholder interactions, greater responsiveness to asset management firms and to the proxy advisory firms. So there's also another thing that we just wanted to draw out. How are these metrics incorporated into the incentive programs? By and large, they're in the annual incentive programs in the US and not in the LTI plans, with few exceptions. And then within the annual incentive plans, the most common way that they are included as just as a discretionary evaluation in individual performance. So that's almost half of the companies that have it included that way. The next most prevalent, 32% of the companies have a specifically weighted metric. And then lastly, 23% of the companies use a scorecard approach. So again, it's a bit of a walk before you run. We're seeing more and more companies tie comp to ESG metrics, but they're doing it in a qualitative way in the short-term plans as a first step. We do expect over time, with pressure from shareholder groups, that it will become more quantitative. And that it will also migrate more to the long-term plans, because by and large, these are measures that need to be monitored over the longer term. And with that, I'll turn it over to Olivia.
Yeah, thanks, Deb. And we can head to the next slide. As part of our ESG research this year, we also wanted to take a look at how COVID may have impacted some of these trends. So as we all know, the COVID-19 pandemic really took hold in March, which was just after most companies had already set and approved their goals for the year. But as you might have expected, it ultimately wound up having a significant impact on incentives in 2020 anyway. Ultimately, I think the broadest takeaway was that the pandemic increased the need for and the use of discretion in determining incentive outcomes at many of the most affected companies. So given the volatility and disruption in 2020, when it came to the end of the year, most boards had to rely on a pretty wide range of non-standard metrics and KPIs when they were judging executive performance for the year, which ultimately winds up showing up here in some of the year-over-year trends that we saw in the ESG metrics. So you'll see that safety metrics registered one of the largest year-over-year increases for fiscal 2020, with 89% of those that added in 2020 explicitly tying the metric to their response to COVID-19. As you can see from the pie charts below, the bright blue portion of the pie chart on the right is that nearly a quarter of all safety metrics in the S&P 500 are those that were added in 2020 in response to the COVID pandemic. So actually, the design of some of these metrics supports the tie to COVID. So nearly all of the COVID-related safety additions were incorporated into individual components, which implies that what happened was that boards considered the company's treatment of employees during the pandemic, like employee health and safety, employee well-being, in a retrospective or backward-looking assessment of executive performance. So as such, we don't think that safety's relative prominence is likely to be permanent, and we're likely to see a reduction next year. We think that customer satisfaction, which is the number 2 year-over-year gainer, was actually subject to similar trends, with boards using customer satisfaction scores to judge executive performance at the end of the year in light of many of their original quantitative goals becoming unachievable pretty quickly after the start of the year. So while the fact that the COVID-19 pandemic drove such a large portion of safety adoption may make the focus on employee well-being seem sort of transient almost, we would point out that this movement is, as Deb mentioned, it's part of a larger trend around responsibility to a broader group of stakeholders. It seems that many more companies wound up feeling the need to disclose their approach to employee well-being than they might have if the pandemic had taken place a decade or 2 ago, particularly as investors have real-time called on companies to demonstrate their responsiveness to all stakeholders. And so finally, as Deb mentioned, D&I is not only the most prevalent ESG metric in S&P 500, it was also one of 2020's biggest year-over-year gainers, with a full 19% year-over-year increase in prevalence in the S&P 500. So although adding a metric can often be a lengthy process, especially if it's not a metric that's already regularly measured and tracked, many companies were clearly spurred to add the metric fairly quickly in response to the increased focus on racial inequality in the US in 2020. So last year, we hypothesized that companies may have been slow to initially adopt a metric due to many of the challenges around measuring it, around setting targets, and especially around disclosing their performance every year. And these challenges become especially obvious for the inclusion half of diversity and inclusion. But a lot of companies now seem to be attempting to circumnavigate some of these challenges by integrating it as a more qualitative component, as Deb said, in sort of a walk before you run, whether they do that through individual performance assessments or just as a year-end discretionary modifier. So also, as Deb mentioned, we would expect to see that with increasing pressure on these issues, the designs are going to evolve from sort of these qualitative discretionary components to more quantitative components going forward, as companies get more comfortable with measuring and disclosing their D&I performance. So in fact, we would also mention that the data on this page only captures companies that included an ESG metric as part of their 2020 program. And we've already seen in the early part of 2021 a wealth of headlines around companies that are incorporating D&I and other ESG metrics as part of go-forward programs. So maybe here we can take a look at the next slide for a few examples of case studies. Alliant Energy on the left is a good example of how a company has integrated ESG goals into their STIP. So full 30% weighting of their STIP is based on ESG goals, 15% based on customer experience, 7.5% are environmental, and for now they're tied to a carbon emissions goal, which for their annual plan is tied towards incremental progress towards a 50% reduction in CO2 levels by 2030. And then another 7.5 is based on diversity and inclusion, split equally into goals around representation of women and people of color. So we ultimately thought that this was a pretty clean example of including multiple ESG goals, all of which have distinct weightings. They've clearly defined success up front, and for this company, they do so through quantitative targets. And as you'll see, they disclose actual performance, even for the metrics for which it's below target. Prudential Financial on the right is an interesting example of a company that actually includes ESG metrics in their LTIP, and they include it as a plus minus 10% modifier on their final performance share payouts. So although for the past couple of years, their goals have been around targeting improved representation, specifically for senior management, in 2021, they expanded this metric to focus on all organizational levels. So this example, similar to Alliant, has clear goals for representation and engagement, and it's interesting that no change on their representation goals over the 3-year period results in a negative modifier. And so we also thought we'd bring up, although it's not on this slide, Marathon Petroleum is another fairly clean example of a company that includes environmental metrics. 20% of their STIP is devoted to sustainability, although they've included safety in that bucket. Again, with full disclosure around the weights of each of the components, 5% each are devoted to greenhouse gas emissions, the environmental incident rate, and 2 separate safety metrics. Finally, as has been alluded to, there have been a fairly large number of blue chip companies that have just made headlines this year for adding ESG metrics over the past few months. So McDonald's and Chipotle have disclosed that they're going to devote 10 to 15% of their STIP to diversity and sustainability goals. Apple is going to include a 10% modifier in its STIP for broad ESG goals. Starbucks is actually going to include a 10% modifier in its LTIP around representation goals. And then Google, MasterCard, and Nike have all also stated that they're going to be incorporating ESG goals, although they haven't released full design details yet. So we fully expect the prevalence and types of designs to have evolved by the time we get around to seeing 2021 proxy disclosures. With that, I see we've got a number of questions, so I'm going to turn it back to Bridget for the Q&A section.
Thanks, Olivia, and thanks to Deb and Emily and JF for their comments this afternoon. As stated, this is our opportunity for the Q&A, and we're, again, thankful for those that have already asked questions. A reminder to others that you can continue to submit questions via the live event Q&A feature, and we'll do our best to answer all the questions that have been posed and that come up. Very quick one, just to, in case others are wondering, because this question did come up, will the presentation be shared with attendees? Answer is yes, and there will also be a recording of the webinar made available. So if you had to jump off, or if you came in halfway through, or whatever happened, life got in the way, you can rewatch and peruse at your leisure later on. Okay, so looking at the specific questions. So our first question, JF, why don't we start with you? The question here is, given the breadth of possible ESG metrics, do you see companies including a single ESG metric, a few metrics, or establishing an ESG scorecard to measure multiple metrics?
Good question. I would say in the short term, I do see the appeal of having a more of a scorecard approach. Like the TSX 60 data, that what it shows, like that's the most visible example if you want to benchmark yourself right now. This is the most common probably part of your peers. And before getting into an actual target and measures, sometimes you want to do benchmarking and you would like to see more disclosure. So I do see the appeal as short term, but also in terms of the participant, it's an easier sell to have a scorecard that you can fine tune, and you can have a number of measures that can balance each other if the calibration is not quite there. So that would be my answer for the short term. Now, how this may evolve in the future, well, if we think about performance, like in general, an incentive plan, not ESG specific, but in general, the way shareholders and company are thinking about performance, it's way more broad than 3 measures, for example. There's a bunch of strategic, operational, financial measures that are kind of trickling in the definition of performance. But in the incentive programs or how shareholders are looking at the performance of a company, there's a handful of measures that kind of emerge from that bunch of underlying measures that the companies are looking at. So if I think on how it may evolve in the future, we might be able to see something similar with ESG, where right now there's a bunch of measures, but then there might be leading measures or 1 or 2 measures that are highly correlated with others that you have in your company scorecards, or 1 or 2 or 3. That might be the way further, but this is the future.
Yeah, and I would just add to that, AllianceBernstein recently came out with a position paper, and they indicated they wanted to be quantifiable. They wanted to be at least 1 metric, but no more than 2 or 3 for the, the points that JF's mentioning. You can get too diluted, right, where you're really just chasing too many things. And they did say they also want to see it as a standalone metric. So I completely agree with in the US that it matches where JF said it is today as far as a scorecard, more qualitative. But I think it will be evolving to much more quantitative, single isolated, metrics of, 1 or 2 or possibly 3, very much aligned with the business strategy of that particular organization.
Great. Thanks, JF and Deb. That's really helpful context. Our next question here relates to where ESG metrics should live within the incentive plan. And maybe start with Emily. As ESG metrics or ESG type metrics continue to increase in prevalence, where are they best suited? Do they belong more in the short-term incentive plan or in the long-term incentive plan?
Sure, yeah. So as Deb and JF both pointed out, right now we are seeing the majority of ESG metrics housed in the short-term incentive plan. But I would say, given the long-term nature of many ESG metrics, there is a natural tension that exists when trying to use ESG metrics in short-term plans. And I see, this was pointed out in another question, which is why have metrics been focused on STIP to date? So some metrics may more naturally fit into an STIP plan. So for example, employees, customers, health and safety, they may just naturally lend themselves to an annual bonus, versus perhaps the environment related metrics such as a carbon footprint or greenhouse gas emissions may be better suited to an LTIP. And I would also say that as companies get more comfortable with measurement of these ESG metrics, the STIP represents a somewhat lower risk way to incorporate these measures. So if the adjudication of these measures at the end of the year is challenging or there's tweaking to be done, it's easier to adjust the STIP year over year versus waiting 3 years for the LTIP. So I expect that that's why we've seen more in the STIP. But as Deb mentioned, we do expect that over time, we will see an increase of these metrics in the long-term incentive plan, but there is a rationale for measures included in both the STIP and the LTIP, depending on the company's circumstances, comfort with measurement, and the metrics that they've decided to use.
Thank you, Emily and Deb. The next question, and maybe Olivia provide a US perspective on this one, and then we can get a Canadian perspective as well. But do you see ESG metrics measured relative to industry or peers at this point, or are they predominantly absolute, i.e. measured against internal goals?
Yeah, at least in what I've seen, it's entirely absolute at this point, and that I can't even think of a single relative metric. Although I do know, as far as relativity goes, many of our clients are very attuned to peer benchmarking on metrics and are very attuned to which metrics are peers including, how are they including them, which metrics are the broader industry including. So there is an element of relativity there, but as far as measuring, it's all against internal goals. And I would say this is due in large part to the lack of standardization in the ESG metric space, where, I mean, not only companies, but investors are also struggling to compare performance across companies because it's not standardized as to what to disclose, how to disclose it, where to disclose it. So as standardization becomes more common and companies adopt similar frameworks, I think that measuring some of these metrics relative to peers or industry norms might actually be a pretty good way to get around some of the challenges around measuring and setting targets. So I know, for example, safety metrics for many companies are measured relative to industry norms. And so could see this becoming more common in the future as things become more standardized.
Yeah, that's great, Olivia. I think we probably just echo from a Canadian perspective, everything that you've articulated would hold true in this situation too. We're not aware of an organization that has managed to figure out how to set these goals on a relative basis or what the benchmark would even be at this point in time.
Exactly.
And to see, but definitely something to be watching over time, how this will evolve. Okay, our next question relates to the board oversight and governance of ESG. Deb, maybe I'll start with you. There's a question as to, we have a governance committee, an HR committee, and a risk committee. How does the board effectively oversee ESG given these disparate groups, and where does the responsibility lie?
Yeah, and it's a great question, and certainly one that's evolving. We're spending a lot of time with our clients just helping them to think through for their particular fact pattern, where should this sit? I would say the most prevalent thing we're seeing at the moment is actually to have it monitored by the particular committee that would monitor those types of metrics. So the human capital metrics like D&I and talent and culture and stuff by the human capital committee. Uh-oh, can you still hear me?
Yep.
Oops. Can you hear me again? I'm sorry, I think I phased out for a minute.
Yep.
Okay, sorry about that. So, and then, the risk committee, overseeing those types of things that are more on the environmental side. And then, the governance committee covering the governance metrics. I would say a couple of things on best practice. We think that it needs to come together somewhere. So even if it's a deep dive on the particular components in one of the committees, it should either go to the full board, at least annually, to sort of bring it all together. Or we do sometimes see companies creating a separate ESG sustainability committee, and then they will bring it all together. But I do think in general, it's going to be a combination of a deep dive into the particular metrics at the committee most appropriate for that, and then bringing it all together either at the board or a designated committee just for that purpose.
Great, thanks, Deb. I think we have time for one, maybe two more questions. So our next one is a longer one, but it's important, so I'd like to address it. The question is, there are a huge number of ESG related issues. Placing them in compensation structures is very difficult as each is very dilute or dilutive. In addition, the correlation between each of these multitude of issues and share performance is tenuous. Doesn't this mean that we should rely more on share price outcomes for compensation, as good outcomes must come from good ESG strategies and performance? If good ESG performance does not result in good share price outcomes, it is irrelevant to shareholders. So lots of, it's a complex question, lots of stuff to unpack here. And, you hit the point where we would agree that it's certainly a complex and challenging exercise to meaningfully incorporate ESG into comp programs. Likely why we're seeing companies, as Deb mentioned earlier, very much a walk before you run type of approach. And I'd also say that overall, the impact of ESG outcomes and performance on compensation outcomes right now remains very limited. For large organizations, especially, so the TSX 60, the S&P 500, the primary driver of realized compensation and wealth creation for executive teams remains share price performance via their long-term incentive programs. So their stock options, their RSUs, their PSUs, how the stock does is the closest correlation, has the closest correlation to their overall comp realized at the end of the day. As we've touched on throughout the webinar today, we may see the direct impact of ESG continue to increase over time, but we're not seeing certainly any massive shift away from stock performance being a primary driver of compensation outcomes, not in Canada. And I'd be surprised if Deb or Olivia have a differing view in the US, where comp tends to be even more heavily weighted towards longer term incentives than in the Canadian marketplace. So there's that piece of the puzzle. Then there's also the comment around whether or not this is relevant for shareholders. And the reality is that in large part, the push for inclusion of ESG metrics in comp programs is coming from the shareholder community. And yes, there remain some skeptics, but the majority of the most sophisticated institutional investors have embraced this movement towards ESG, are demanding it, frankly, from their investee companies, and are being very vocal about it. And beginning, as we saw with some of the shareholder votes that we were reporting on, beginning to actually use their votes and use their voice there in demanding these types of factors be integrated into comp programs. And there's also the recognition, or the broad societal recognition and endorsement, driven again in large part by the institutional shareholders, that corporate North America is no longer responsible solely to shareholders, but there's the accountability to all stakeholders, and then inclusion of ESG as a strategic pillar and how it gets incorporated into compensation is consistent with that movement and messaging. Would be Deb, I don't know, we've got like 1 minute. I don't know if you'd add anything different from your perspective in the US.
No, I mean, I think you said it well, Bridget, and I think that all applies. I mean, the only other thing I would say is it's true that shareholder return is always going to be probably the largest component of executive compensation, but there's also the concept of line of sight and what can they control. And so I think having those specific metrics where they can see how they move that dial very objectively, and then that does translate to some part of their incentive payout, which then in turn, as you're saying, or as the question alluded to, should also link to long-term shareholder returns. But it's kind of having that step process of something that is more in their line of sight, more controllable, more short-term measurable.
Right.
I also, just to add, I think I remember reading an article that was done on companies in Europe looking at the link between ESG metrics and long-term share price performance. And what they found is that many of the metrics did correlate with long-term share price performance, but many of them don't show up for 5+ years in share price. And so a topic that had come up for us even before this focus on ESG was whether long-term performance periods are predominantly measured over 3 years, and whether that is too short to really capture the drivers of long-term success for the company. And so there being sort of a disconnect between the time horizons of when ESG metrics show up in share price and sort of the time horizon over which executives are judged, and even typical executive tenure seems to drive some of this push towards directly incorporating ESG into incentives rather than just letting it slowly show up in stock price 8 years down the line.
Right. Fascinating, and we could, I'm sure, go on and on and on, but unfortunately we're at the end of our time, and respecting, I'm sure you're all very busy. So once again, thank you everyone for joining us this afternoon. If we didn't get to your question, apologies, and please don't hesitate to reach out to any of our consultants or contact us. Emails on our website. One final request for participants to fill out the short survey that you'll receive, and as a reminder, you will get the deck, and there will be a recording of the webinar posted. Thanks again all for attending, and thank you to the panelists for participating and sharing your insights. Have a great day, everyone, and stay safe.
Thank you.